Okay, so we want to look at now. We want to look at now the second aspect of this, or types of responsibility accounting. Now we want to look at what they call the profit center. Now, of course, you know a profit center is a segment of the business entity by which both revenue and expenditure are controlled. So is what they call. So which means any segment of that business organization that control the revenue and the cost together at the same time, that particular division can be referred to a profit center, which means they actually incur both the generate revenue and also incur cost for that organization. So, which means, and also you should know that the component of profit are revenue and cost. So, which means as long as that particular division generates revenue and at the same time, incur cost, that particular division can be referred to as a profit center because the two major components of profit are revenue and cost. So we call them a profit center, which means they generate both revenue and the cost. Then, of course, the third one is called the investment. The investment center. Yeah. Now, of course, an investment center is a profit center controlling revenue and cost. But in addition, in which but in which in addition the profit is related to the asset employed in earning that particular profit. So we call it investment center, which means, of course, here it's talking about here this particular center is not just a center or a particular division that generates revenue and incur cost. In addition, also that particular center or division, the company has so much as a whole has so much make an investment, in terms of acquisition of assets into such particular division, and those assets has a capacity of generating a profit for that particular division. So that division can be referred to what they call an investment division. It's not just a division that generates profit. It's also a division that the company as a whole has made so much investment into that particular division, and that investment has a way of generating, has a way of generating additional profit for such division. So these are three major types of responsibility accounting we're having. So now we want to now look at the method of evaluating divisions. Now, remember we're looking at what are the methods we can use to evaluate divisions. Methods of evaluating divisions. Which means if a company wants to evaluate the performance of a particular division, remember as I said, each division are headed by what we call a divisional manager. Yeah, because those divisions must be managed by somebody, and that person is called a divisional manager. Now, at the end of the period, how do we, evaluate the performance of each of those divisional manager at the end of the day? Because we need to evaluate their performance so that we can know, okay, which of those divisions are performing well and which of these divisions are not doing well. So that's the essence of what they call the divisional evaluation. So, now we want to look at three. There are actually three ways you can evaluate the performance of each division. We can use what they call return on capital employed, or you call it return on investment, return on investment. The second one is called residual income. The third one is economic value added. So these are three major methods that we can use to evaluate the performance of a particular division. These are the three major methods that is normally used to evaluate the performance of division. So now let's start looking at what we call the return on capital employed. employed, or you call it return on investment. You should know that now return on capital employed, it measures the relationship between the capital or assets employed with the earnings generated by the division. Which means if we want to use return on capital employed to measure the performance of a particular division, what we are trying to do here in measuring the performance here, we are trying to measure the relationship between the investment the company made into that particular division in relative to the profits that particular division is generating. Because if I made investment in something, I should be able to generate profit or earnings from the investment I made into something. So here, return on capital employed, we are trying to measure the relationship. We are trying to measure the relationship between the investment the company made into that particular division in comparison or in relative to the earnings or profit that particular division is generating, is what they call the return on capital employed. So, which means now, here, how do you calculate return on capital employed or return on investment? We are going to say return on investment or return on capital employed, which is ROCE, return on capital employed, is the net profit over capital employed. This capital employed can be, or you call it investment, because investment are then times 100. Then times 100. So this is formula for determining the return on capital employed. Remember, it's net profit, the profit you generate as a result of the investment. This is the investment, the value of investment you put into that particular division. That's capital employed or investment or asset. It can be investment, can be capital employed, can even be asset. Any of these three, then times 100. So, of course, we'll now look at that. So this is going to show the relationship between the profit generated and also the investment the company made into that particular division. So that is what the return on capital employed is all about. So you should know it's very, very important. So let's now go to the second, called residual income. Let's look at residual income. Now, when we say residual, the second one is called residual income. Residual. Now, residual income is an income the company generated after the deduction of imputed costs, or after deduction of what you call the interest cost. Now, what are we talking about here is this. When a company generates a net profit or a particular profit, you should know that that profit comes from a particular investment the company made into that particular division. And most of the times, when a company invests their fund or resources in a particular division, those resources could be borrowed, or that particular fund that was invested could be borrowed from a financial institution. And you should know that when you borrow a particular fund, okay, so the second method we can use to measure the performance of a division is what they call the residual income. Yeah, is the residual income. And of course, residual income is sales revenue less controllable divisional costs and interest imputed on divisional investment. What is he talking about here is this. Of course, the sales that particular division generates minus the controllable expenses or costs will give you the net profit. By the time you remove the net profit or you remove imputed costs from the net profit, you are going to have what you call residual income. Residual income simply means net profit minus or less imputed cost. Imputed cost simply means here the interest costs. Now, the concept behind residual income is talking about here is that most of the times when a company invests in a particular division, most of that money that the company used to invest in that particular division must have been borrowed from a financial institution, of course. And the financial institution, most of the times, might kind of charge a particular interest on the amount that was borrowed and all that. So, which means by the time we want to measure the performance of a division, the net profit they generate, which means the revenue they generate minus the controllable cost they incur, is going to give us the net profit. So the residual income is, by the time we remove the interest costs as a result of the borrowing from that investment, what is left is called the residual. That's what is called residual income, which means residual income, RI, is equals to net profit less imputed costs. And of course, when we say net profit, and net profit, an imputed cost is that, for you to get imputed cost is is the rate of interest times the value of investment. That's going to give you your imputed cost, which means the rate of interest. Let's assume when you borrow that particular amount of money you invested, you are charged 10%. So 10% on the value of the money you borrowed, that's going to give you your imputed cost or interest cost. So removing from the net profit, whatever is left is called the residual. Residual means remaining income. So remember, there are three methods on how to measure the performance of division. But we are going to actually restrict ourselves to only these two methods of value. Okay, now we want to look at the question under this. This question is talking about the, Parkex is a division of an automobile group and has a 5. So, okay, let me just go to the requirement. When you go to the question, you are going to understand what the question is all about. They said require A, prepare a summary of the statement of profit, statement of management investment proposal for the year 1 to 5, showing residual income, return on capital employed for each year using straight line depreciation method. B, comment on the use of the figures from the statement in the A above as a decision making and management performance measure. C, calculate residual income and return on capital employed for you are using the alternative proposal. Yeah, that's alternative proposal. So now, of course, A. Now let's go to the A part of the question. The A part of the question says we should calculate the A. Now, want to calculate this is a company, Parex. Parex is a company. They say we should calculate a statement of profit. So statement of profit. Statement of profit. They say from year 1, you should calculate from year 1. Okay, let me just 1, 2, 3, 4, 5. They say you should calculate from year 1 to 5. Yeah. So in that case, if you are going to determine now the profit or loss. Okay. So in this case, remember, we want to now look at now, because the question says we should determine the summary of the statement of management investment proposal. Because remember, the management want to propose a particular investment on all that. So in that case, of course, as I said earlier, the first thing is that we have what you call an opening investment. Opening investment. Now, of course, when we say opening investment, remember, in this question, we are told that the company, because they say the management is proposing an investment of 48 million on the immediate improvement to the interior of the premise in order to stimulate sales by creating more effective selling environment. The following information. So, which means what the management actually invested in that particular proposed investment is 48 million. I remember it's part of your investment. So 48 million is the, so okay, let me have 3 naira sign here, 3 naira sign there, 3 naira sign, so that we can reduce the number of the figures. Okay, 48 million, that is what we propose. That is what the management proposed, 48 million. But remember, if you go back to the question, we are told that we should use straight line method to depreciate. Of course, an investment can be in form of an asset. Of course, you should know that when you say investment here, when you acquired a machine or you acquired a land, when you build a house, it's all about investment. Yeah, and you should know your investment on the acquisition of non-current asset can actually depreciate in value. So which means every year you must calculate depreciation. If today the value of your asset is 48 million, you can't expect by tomorrow the value will be the same thing because of depreciation on a particular asset. So in this case now, so which means in this case, uh, uh, we have to go a kind of a, So now, for us to now determine how much is that, so 48. Remember, as I said, well, they say we should because the second year, the value of this investment might not be the same thing in the second year. Yeah. So, which means in this case, we have to go and calculate depreciation. Like, okay, depreciation. If we calculate depreciation, if I say 48 million divided by 5 years, how much is it going to give me? 48 million divided by 5. How much? 48, okay, divided by 5. Okay. So 48 million divided by 5. If you say 48 million divided by 5, the depreciation is going to be 9 because remember that proposal is for 5 years. So we have to divide 48 divided by 5 years to give us the annual depreciation. Yeah. So which means our annual depreciation is 9.6 million. That's our annual depreciation. So which means every year the value of this asset will reduce by 9.6 million. So which means here